What if everything you've been told about your RRSP is actually making you poorer in retirement, not richer? Recent data suggests up to 40% of Canadian retirees with significant RRSP balances end up paying more tax on withdrawals than they initially saved, effectively turning their tax deferral into a future tax bomb. At 2, I'll expose the hidden tax trap, and at 4, how your RRSP can cost you vital government benefits. But first, here's mistake number 1, happening right now to thousands: blindly deferring taxes without projecting your retirement income, potentially costing you thousands in higher future tax rates. You've been diligently contributing to your RRSP, believing you're doing the right thing for your retirement. But many Canadians are unknowingly walking into a financial trap, losing out on government benefits, facing unexpected tax hikes, and making crucial investment errors within their accounts. Imagine saving for decades, only to find out in retirement that your hard-earned money triggers massive tax bills and reduces the very old age security, OAS, or guaranteed income supplement, GIS, you were counting on. At 2, I'll expose the hidden tax trap, and at 4, how your RRSP can cost you vital government benefits. But first, here's mistake number 1, happening right now to thousands: blindly deferring taxes without projecting your retirement income, potentially costing you thousands in higher future tax rates. You've been diligently contributing to your RRSP, believing you're doing the right thing for your retirement. But many Canadians are unknowingly walking into a financial trap, losing out on government benefits, facing unexpected tax hikes, and making crucial investment errors within their accounts. Imagine saving for decades, only to find out in retirement that your hard-earned money triggers massive tax bills and reduces the very old age security, OAS, or guaranteed income supplement, GIS. This next mistake affects 73% of Canadians, and it's costing them roughly $12,000 per year in lost benefits. In this video, we'll uncover the hidden tax traps, show you how your RRSP can claw back vital government benefits, reveal the true winner between TFSA and RRSP for most Canadians, expose common investment blunders, and guide you towards smarter retirement accounts and portfolio balancing strategies. This next strategy is what separates those who struggle from those who thrive in retirement, so keep watching. Trap number 1, the illusion of tax deferral. Many believe an RRSP defers taxes, which is true, but it doesn't eliminate them. If your tax bracket in retirement is higher than when you contributed, you could pay more tax overall. Consider someone who earns $60,000 contributing at a 30% marginal rate, then retires with substantial income or other assets that push them into a 40% tax bracket during withdrawals. They saved 30% up front, but pay 40% later, potentially losing thousands. Estimate your likely retirement income and marginal tax rate now. Compare it to your current rate. Understanding this helps you avoid a nasty surprise and optimize your tax planning. If this has already opened your eyes, give this video a thumbs up now. Trap number 2, losing out on government benefits. Your RRSP withdrawals are considered taxable income in retirement. This income can push you over thresholds for old age security, OAS, and the guaranteed income supplement, GIS, causing these crucial benefits to be reduced or even eliminated. For example, if your net income exceeds roughly $86,912, 2023 figures, your OAS will be clawed back. Every dollar of RRSP withdrawal after age 71 contributes to this. Charts OAS clawback thresholds over time. This next error costs Canadians an average of $6,500 annually in lost benefits. Learn about the OAS GIS income thresholds and factor your RRSP withdrawals into your retirement projections. Proactive planning can help you structure withdrawals to maximize government support. Strategy number 1, TFSA versus RRSP, the true champion. For many Canadians, especially those in lower to middle income brackets or those expecting higher income in retirement, the tax-free savings account, TFSA, offers a superior tax advantage, as withdrawals are completely tax-free. If you anticipate a higher income in retirement, for instance from a pension or other investments, or if your current income is modest, the TFSA often provides better long-term tax efficiency than an RRSP. TFSA equals tax-free withdrawals. This next strategy is what me and my clients use to save on average $10,000 in taxes over their retirement. Reevaluate your current and projected retirement income. Prioritize TFSA contributions if you expect your retirement tax rate to be similar or higher than your current one. This can lead to significantly more spendable income in retirement free from tax worries. Trap number 3, the inevitable tax bomb. Unlike a TFSA, your RRSP must be converted to a Registered Retirement Income Fund (RRIF) by age 71, and minimum withdrawals begin which are fully taxable. This can force income on you whether you need it or not. If you have a large RRIF and other retirement income sources, these mandatory withdrawals can compound your taxable income, pushing you into higher tax brackets and triggering significant clawbacks on other benefits. Here comes what me and my clients learned after making this mistake. Develop a comprehensive withdrawal strategy that considers RRIF minimums, other income sources, and potential tax implications before age 71. A strategic withdrawal plan can smooth out your income and minimize your overall tax burden. Mistake number 1, suboptimal RRSP investments. Many Canadians hold low-growth, low-return investments like GICs or basic savings accounts within their RRSPs, missing out on the compounding power of equities that tax-sheltered accounts are designed for. An RRSP with $100,000 earning 2% versus 7% over 20 years results in a difference of hundreds of thousands of dollars. You're losing potential growth if your funds aren't invested strategically. 95% of people don't know this next information. Review your RRSP holdings. Are you appropriately diversified and invested in growth-oriented assets suitable for your risk tolerance and timeline? Optimizing your investments within your RRSP ensures your money works harder for you, maximizing your tax-sheltered growth. When the RRSP backfires, beyond tax deferral. For individuals with a lower expected retirement income, or those whose main goal is to qualify for maximum government benefits, an RRSP might not be the optimal vehicle, especially if it pushes income thresholds later on. If your primary goal is to ensure maximum GIS, significant RRSP withdrawals could jeopardize that, whereas a TFSA would have no impact. This next tip can save you up to $800 a month in government benefits. Consult a financial advisor to determine if your specific retirement income goals align with an RRSP. Avoid misaligning your saving strategy with your actual retirement needs, potentially leading to a more secure future. If you've reached this far, it's because you truly want to secure your financial future. Keep going. Even high earners can get it wrong. Even high-income earners who benefit greatly from the initial tax deduction can get poorer if they don't plan their withdrawals carefully, fail to consider estate planning, or don't utilize other advanced strategies. A high earner with a large RRSP who doesn't strategically withdraw funds before age 71 or fails to consider spousal rollovers could face a massive tax bill upon death, eroding their legacy by hundreds of thousands. Graphic, estate tax burden example. Stop everything. This next tip might save your family up to $50,000 in probate fees. High-income earners should seek advanced financial planning to optimize RRSP/RIF withdrawals, consider charitable donations, or other strategies to mitigate future tax liabilities. Ensure your wealth is preserved and transferred efficiently even with a high income. Early retirement? Watch out for RRSP penalties. While attractive, withdrawing from an RRSP early comes with immediate withholding taxes and the full amount added to your taxable income for that year, potentially pushing you into a higher tax bracket prematurely. Withdrawing $20,000 from your RRSP in your 50s for early retirement might incur 20% withholding tax in most provinces, but the full $20,000 is then added to your income, which could result in an even higher tax liability, potentially costing you another $2,000 to $4,000 in unexpected taxes. Graphic: withholding tax rates by province. But wait, there's something even worse than this. If considering early retirement, build a separate bridge fund outside your RRSP, like a TFSA or non-registered account, to cover early expenses without penalizing your retirement nest egg. Avoid unnecessary taxes and preserve your long-term retirement savings by planning alternative income sources for early retirement. Smarter accounts beyond the RRSP. Beyond RRSPs and TFSAs, Canadians have other powerful tools like non-registered accounts for maximum flexibility, employer-sponsored pension plans, and potentially even corporate structures for business owners, each offering unique advantages. A non-registered investment account, while taxable annually, offers full control and no forced withdrawals, making it excellent for bridging early retirement or specific goals. Employer plans often come with matching contributions. That's free money, potentially adding thousands to your retirement. Graphic: example of employer matching contribution notice. This next point clarifies the biggest misconception about Canadian retirement planning. Explore all available retirement savings options, including any employer-sponsored plans, and understand how they complement your RRSP/TFSA strategy. Diversify your retirement savings strategy to build a robust and flexible financial future. Optimize your mix. Is your RRSP too big? An overfunded RRSP means you have too much capital tied up in an account that will face significant tax liabilities and potential benefit clawbacks in retirement. Balancing your RRSP with other accounts, like a TFSA or non-registered account, is crucial. If your projected RRIF withdrawals alone are enough to push you into a high tax bracket or trigger significant OAS clawbacks, consider diverting future savings to a TFSA or a non-registered account to spread out future tax events. How many of these errors are you currently making? Tell me in the comments. Perform a retirement income stress test to project various withdrawal scenarios and their tax implications across all your accounts. Rebalance your contributions accordingly. Achieve optimal tax efficiency and income flow in retirement, maximizing your spendable income by thousands annually. The common belief that an RRSP is always the best choice for retirement is a dangerous oversimplification. Ignoring these hidden traps and smarter strategies could cost you hundreds of thousands of dollars over your retirement. Remember, it's not just about how much you save, it's about how you save it and how you plan to use it. Your financial future isn't predetermined. It's shaped by the knowledge you gain today and the actions you take tomorrow. If this deep dive into RRSP truths has opened your eyes, please give this video a thumbs up, subscribe to our channel for more crucial financial insights, and tell us in the comments what's one immediate change you'll make to your retirement plan. Your journey to a truly richer retirement doesn't just start with saving, it begins with informed saving. Take control, ask the right questions, and build a retirement plan that genuinely serves your best interests, free from unexpected burdens. The power to transform your financial future is in your hands, starting now. Next week, we'll expose the 3 secret TFSA strategies that can add an extra $50,000 to your retirement completely tax-free. You won't want to miss it.